Over the course of 2024, the market has continued to hit new all-time highs, which has been great for my personal portfolio, but it has made it more difficult to find opportunities in this market. But over the past month, we've actually started to see some sell-offs in a few dividend stocks. So in this video, we're going to be looking at 5 different dividend stocks that are currently trading very close to a 52-week low. So let's go ahead and dive in. Our first stock is right at a 52-week low, and that is PepsiCo, stock ticker PEP. We can see the current share price is about $157 per share, and the 52-week low is pretty much $156, which they hit just the other day. Now, if we look at it in the past year, they're down about 5.72%, which is obviously pretty bad compared to the market over the past year. But look at the past month alone, down around 11%. Just around 30 days ago, they were trading on the upper end of their 52-week range, trading at about $176 per share. Again, now down around 11%. So what's the reason for this huge sell-off? Well, one of the things we have to understand is a lot of stocks have been impacted by what's going on in the political world right now. For example, we can see here we have an article titled "Big Pharma Reckoning Looms with RFK Jr. Eyeing Pfizer." And the general premise is RFK Jr. could potentially be appointed as the health secretary of the United States. And while stocks that would immediately see an impact from this would be pharmacy stocks like Pfizer, there are some other companies that have concerns because of this, and Pepsi is one of those companies. There's speculation that RFK Jr. as health secretary could look deeper into the ingredients that Pepsi is using to make their products. And if Pepsi is forced to change those products, it would probably increase their cost of revenue, meaning it becomes more expensive to make those products. Now, speaking of profitability, if we jump over to my profitability spreadsheet, let's come up here and plug in Pepsi. And all this data will load in. And real quick, like always, you can download any of my automated spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet by going over to tickerdata.com. There's a 7-day free trial. Now, what I want to point out here, over the past decade, Pepsi has had very consistent gross profit ratios. We come over here, we can see the 10-year average is sitting at about 54.28, the 5-year pretty much the same at 54.21, and if we look at the last year, it is 54.21. So a very stable gross profit ratio, and in fact, this actually is one of the reasons a lot of people like Pepsi. It's obviously a more mature company with a strong brand, and the cash flows are typically very predictable and very stable. And in my opinion, that's one of the reasons the company typically trades at a premium, even though it doesn't necessarily have high growth rates. The huge concern here is that some of their ingredients could come under scrutiny, increasing the cost of revenue, messing up their gross profit ratio. Now keep in mind, as of right now, this is purely speculation. We have no idea whether or not that'll actually be the case. Now if we look at Pepsi from a dividend perspective, and we can see with the company trading at a 52-week low, it's bumped up that starting dividend yield. It's sitting pretty nice right now at 3.34%. And again, historically speaking, this is a dividend king, meaning they have over 50 consecutive years of dividend increases. And the 10-year dividend CAGR is sitting at about 7.54%, and the 5-year dividend CAGR is sitting at about 6.7%. So decent dividend growth over the past 10 and 5 years for a company that's been increasing dividends for 50 consecutive years. Now here's a little bit of the concern. If we look right here, we can see the free cash flow payout ratio is now sitting at 84.33%, meaning they're using the majority of their free cash flow to pay out dividends, leaving very little left over to reinvest back into the business. And if we look at over the past 10 years, the free cash flow payout ratio over time has been increasing. And in fact, in 2022, they actually didn't generate enough free cash flow to cover dividends, which is obviously not sustainable long term. So there's a little bit of a concern there. Now, if we start to break this down a little bit more, let's look at the past few quarters. What you'll notice is we'll start to see a trend. Q1 of each year typically has negative free cash flow, and then Q3 is going to be one of their higher quarters of free cash flow every single year over the past few years. So if we look at just the first 3 quarters of 2024, we can see obviously free cash flow didn't cover the dividend then. Q2, free cash flow didn't cover the dividend either. Q3, the dividend finally covered free cash flow by a pretty decent amount. So it'll be interesting to see what happens in Q4. This will tell us a lot about the sustainability of that dividend moving forward. But if we continue to see a high free cash flow payout ratio, I wouldn't expect very high dividend growth rates moving forward. Now, if we quickly glance at my stock screener, come up here and plug in Pepsi. What I want to quickly do is glance at the company from a valuation perspective. If we come over here, we can now see the company has a free cash flow yield of about 2.88%. Now that's decent, but the growth rate projections aren't very high for this company, so this free cash flow won't be growing at a high rate. And in fact, if we jump back over to Seeking Alpha, let's look at some earnings projections over the next few years. If we scroll down, we can see for the next few years, it looks like we're expecting to see around 6 to 7% earnings growth year over year. That's decent for a company as mature as Pepsi. And then if we look at them from a valuation perspective, you'll actually see compared to how they've historically been trading, it looks like they're a little bit undervalued. That price to earnings non-GAAP for the trailing 12 months sitting about 19.84 when their 5-year average is closer to 25. That's around a 20% difference. So again, looks like they're at a discount. The same is true if you look at it forward looking, or even if you use generally accepted accounting principles. It still looks like they are undervalued compared to that 5-year average. So Pepsi is a company that will typically trade at a premium because investors love the history of dividend growth over 50 consecutive years. They love the predictability and stability of this company. But if you're asking me, this sell-off was warranted. I think the company is now trading at a valuation where it could potentially make more sense for some investors. But as for me, I'm looking for stocks with more potential for free cash flow growth and dividend growth. Our next company at a 52-week low is one that's been hammered. That's ADM, Archer Daniels Midland Company, over the past year. They're down 28%. If we look at the past month alone, you can also see they're down quite a bit, down around 5.62%. And we can see there's a sell-off right here when they released their latest quarter's earnings. So let's see what happened right there. Well, if we come down here, we can see earnings were in line, but they saw a miss on revenue by about $1.57 billion. Now, if we go ahead and jump over to my dividend breakdown sheet and plug in ADM, and what we can see is the company has a very nice starting dividend yield, currently sitting at about 3.8%, along with relatively low cash flow payout ratios. So that's a good sign. Free cash flow payout ratio is only sitting at about 33%, and the earnings payout ratio at about 28%. And they have a history of dividend growth as well, with both the 10 and 5-year dividend CAGRs being about 7.5%. So we're looking at a good combination, a nice starting dividend yield, low payout ratios, and a history of dividend growth sitting at about 7.5%. That's a great combo, but we can see it has been a shaky ride over the past decade when it comes to those dividend payments and the free cash flow covering those dividends. But to be fair, the past 3 years, free cash flow has easily been covering those dividend payments, so that's a good sign. Now, one of the concerns I do have is if we jump over to the investor's presentation for ADM, we can see they give us a breakdown of return on invested capital versus weighted average cost of capital. Now, ROIC, remember, this is telling us how profitable are the projects the company is reinvesting their capital back into. And in order to create shareholder value, ROIC has to be higher than the weighted average cost of capital. So these blue and green lines here that are charted out are telling us trailing 4-quarter average ROIC and trailing 4th quarter adjusted ROIC. And what we can see is there are some periods of time when the long-term WACC has been above the ROIC. That's not a good sign. Now, we can see over the past few years it has climbed to a much healthier rate, but again, this is a concern and something to keep in mind. Now, if we look at their projections for 2025, we can see they're telling us they're expecting high single-digit growth when it comes to earnings. And if we come down here, we can see they're expecting a dividend payout ratio of between 30 to 40%. And like we just saw, that's currently where they are, so that's a good sign. They expect to continue to be in that range. And the return that they're targeting is 10% return on invested capital. And this will probably be the metric I pay closest attention to when analyzing them. If we look at the company from a balance sheet perspective, we can see things actually look pretty good. Debt to assets ratio sitting at just 0.23 and the current ratio sitting at about 1.44. So plenty of total current assets to meet those short-term obligations. And if we jump over to the profitability sheet, again, we're going to see gross profit ratio has actually been increasing quite a bit over the past decade. That 10-year average sitting about 6.37, and last year's gross profit ratio was sitting at 8%. And if you look at where they were in 2013, it was all the way down to about 4.33%. So this is a great sign. Steadily increasing the gross profit ratio over time can be a great way to boost your earnings. And so if we look at ADM from a valuation perspective, they currently have a free cash flow yield of 12%. That is very high. And if we jump over to Seeking Alpha, let's look at how they've historically traded. If we click on the valuation tab and come over here, we can see when it comes to price to earnings valuations, again, compared to how they've historically traded, it does look like this company is undervalued. Again, I do have concerns about the return on invested capital moving forward, and growth rate projections aren't very high, and this is a cyclical company, but it looks like there may be potential here overall. Now, the last thing that I do want to mention is, yes, while they are targeting high single-digit growth when it comes to earnings, if we come back over to Seeking Alpha and click on earnings, let's look at what those earnings estimates look like over the next couple of years. We can see next year, yes, they are expecting high single mid digits, just like management team stated, but after that, there's not a lot of confidence that earnings will continue to grow. So again, something to keep in mind. Now, our third company is another one truly right at its 52-week low, and that is Pfizer, stock ticker PFE, trading at $24.88 per share. And look at this, in the past year, yes, they are down around 17%, but look at just the past month alone, down 14.34%. And again, this goes back to RFK Jr. and a lot of speculation with what could go on if he becomes the health secretary. He has stated before that if he does become health secretary, he will be looking at these companies to try to uncover evidence of fraudulent practices. If we jump over to my dividend breakdown sheet and come up here and plug in Pfizer, we can see Pfizer now has a massive starting dividend yield sitting at 6.76%. And let's put this into context. If we look at what Pfizer's dividend has been over the past few years, let's scroll down. What you'll notice is this is actually the highest starting dividend yield that Pfizer has had in the last decade. For the majority of the past decade, we can see their starting dividend yield was kind of in the 3 to 4% range. It's now sitting at 6.76%, so this is a huge starting dividend yield, even historically speaking, for this company. And to go along with that, we can see they have been increasing their dividend over the past 5 and 10 years. Now, the dividend growth hasn't been a lot, but it has been growing. Now, here's the huge concern. Look at these payout ratios. This is obviously not sustainable over the long term, but will that be the case moving forward? If we look at the free cash flow versus dividends paid out, we can see from 2013 through 2022, there was no problem. Free cash flow was easily covering those dividend payments. And then in 2023, free cash flow dropped off a cliff. It went all the way down to about $4.8 billion, while dividends paid out was about $9.2 billion. Again, obviously not sustainable over the long term. So the question for Pfizer is, what's in their pipeline that's going to allow them to continue to grow at a healthy rate so that they can continue to cover and grow that dividend over time? It's clear that their golden days of the COVID vaccine are behind them when they are generating nearly $30 billion in free cash flow. If we jump over to my stock screener and plug in Pfizer, what we can see is Pfizer is currently trading at a free cash flow yield of about 5.84%. But look at this. Free cash flow dropped off a cliff in 2023. It was only about 85 cents. Now, if we look at it in the trailing 12 months, it's bumped up to about $1.45. So we are starting to see some recovery, which is worth noting. Now, if we look at return on invested capital in 2023, again, very low, sitting at only 4.29%. So again, that's slightly below their weighted average cost of capital, meaning they were actually destroying shareholder value. This is pretty much a disaster situation. That's what you never want to see over a long period of time. Now, before that, it was as high as 27% or around 20%, and before that, looks like they were typically sitting around 10 to 12% for the most part. If we look at Pfizer from a price to earnings valuation perspective, let's go ahead and jump over to valuation. Again, we can see this is another company compared to how they've historically been trading that appears to be slightly undervalued. Now, the valuation isn't too far off from where they typically were. We can see currently trading at about a 9.64 price to earnings non-GAAP trailing 12 months, while the 5-year average is sitting at about 10.87. So they haven't typically traded at a high multiple, but they still are slightly below that typical valuation. And if we look at the earnings growth expectations for this company, again, we'll scroll down, we can see yes, they are expected to recover earnings over the next year. 59% growth is obviously very high, but that's really just putting them back to where they were previously. If we jump back over to our stock screener, again, we can see they have a long way to go to get back to where they were, even to just get back to those pre-2020 levels. But then after that, analysts don't really know where their growth is going to come from. And again, it can be hard to project growth when we talk about pharmaceutical companies like Pfizer, because again, that pipeline is constantly changing. As of right now, the growth rate estimates don't look too good. If things don't change in the future, I'd say 4 or 5 or even 6 years from now, we're going to start to see very little dividend growth, and if things get even worse, potentially a dividend cut. Now, perhaps the most interesting opportunity on the list today is going to be ASML Holding. And this is actually a company that is headquartered out of Netherlands. And this company has seen a radical decline in its share price over the past few months. Over the past year, it's only down about 5%. But look at this, in the past 6 months, it's down close to 30%. It hits all-time high of about $1,110 per share and is now trading right at that 52-week low at about $660 per share. Now, if you're not familiar with this company, they're a developer and manufacturer of advanced semiconductor equipment systems. And the equipment they provide is used by companies like Taiwan Semiconductor Manufacturing. So they're in a market that is absolutely exploding. And when we look at this company, we can see a price to earnings multiple of 33. That's a really high price to earnings multiple, even higher than companies like Microsoft. And so when you hear a statement like that, you might still think, oh wow, this company seems like it might still be overvalued. But you have to understand, price to earnings multiples don't do a good job for accounting the future growth of a company. And the future growth projections for this company are simply astounding. If we scroll down, look at this. They're expecting 4 to 5 years of 20% plus earnings growth. So we're talking about a company where earnings are expected to absolutely explode. So what was the reason for the sell-off? Was it simply due to a high valuation? Well, that may have played a role, but there's a bit more to it than that. If we jump over to earnings, we can see back in mid-October, they released their latest quarter's earnings report. And on this report, they actually saw beats on top and bottom lines. But during that day, the stock saw a huge decline. Why was this? And it boiled down to a few different reasons. Now, to start off, this was a pretty chaotic earnings report because to start out, the company accidentally released their earnings report a whole day early. So this came as a shock to investors. They weren't ready for it. And that likely only increased the volatility. But the huge reason for the sell-off is we can see third quarter bookings fell 53% quarter over quarter to about 2.63 billion euros. And Bloomberg was expecting about 5.39 billion. So this was a huge difference. And to add fuel to the fire, if we scroll down to the outlook, we can see right here, for the full year 2025, ASML lowered their net sales forecast to about 30 to 35 billion. And previously the company was expecting about 30 to 40 billion. And on top of that, they slightly lowered their expected gross margins. So this was definitely one of the more chaotic earnings reports that I've seen, beating on top and bottom lines, coming out a day early, and then a huge sell-off due to bookings and changes in the outlook. So yes, the short-term outlook was lowered for this company and we saw a massive sell-off, but was a sell-off of over 30% justified? Well, let's keep digging into this, and the first thing I want to do is jump over to the stock screener. We'll come up here and plug in ASML. And what we'll start to see is some pretty phenomenal growth, especially in the past 4 to 5 years. Look at earnings growth, look at the revenue growth. Revenue per share over the past decade has gone from about $12.10 all the way up to around $70. If we look at earnings, 2013, it's sitting at about $2.78, and as of 2023, all the way up to around $20. And this is a company that's generating very, very high returns on the capital that it's reinvesting back into the business. In 2021, return on invested capital of about 39%, 2022, 40.5%, in 2023, 42.26%. If we jump over to the profitability sheet, we can see a 5-year revenue CAGR of over 20%, a 5-year net income CAGR of over 25%. And we can also see gross profit ratio is increasing over time. So even though they just slightly lowered their outlook for gross profit ratio, it's still been increasing over the past decade, with last year sitting at about 51.3. And yes, this is a dividend paying company. If we jump over to the dividend breakdown sheet and plug in ASML, we can see the company has a starting dividend yield sitting at about 1.23%. So when you think about that low starting dividend yield, but in the context of the massive dividend growth and earnings growth and free cash flow growth they could see over the next 5 to 10 years, if you buy in now, your yield on cost will be significantly higher as the years go by. Look at the 10-year dividend CAGR. It's already massive, over 23% in the 5-year, 13.54%. Now, one of the things you do have to also keep in mind is this is a company out of Europe, out of the Netherlands, and dividend payments from European companies can typically fluctuate a little bit more. So yes, while it has increased at a high rate, we can see there have been some years where it's been a little bit higher and then bounced down and then continued to increase. So just something to keep in mind. Now, if we jump back over to the stock screener, we can see the company has a free cash flow yield sitting at just about 1%, which typically doesn't seem like a great valuation, but again, you have to put it into context of the growth they're expected to see. A low free cash flow yield isn't bad if the company's going to be growing free cash flow at a rapid rate, and that's exactly the case for this company. So when I look at this company and I see, yes, a high price to earnings multiple sitting at about 33, but when I put it into context of the growth they're expected to see, this company might actually be at a decent value. Now keep in mind, there will probably be a lot of volatility over the next 4 to 5 years with a company like this. But if you're willing to hold on for the ride, this could be an opportunity and you'll probably see a lot of dividend growth along the way. And then our last company, close to a 52-week low, it's going to be the Coca-Cola company. They're actually done decent over the past year, up about 8.5%, but again, this is another company where the past month has seen a huge sell-off, down around 11%, and it's pretty rare that you'll see a company like Coca-Cola, typically very low levels of volatility. It's rare you'll see them sell off at over 11% in a single month. And again, for the same reason as Pfizer and Pepsi, most likely, there's some speculation their ingredients could come under fire, and if they have to change, there could be cost of revenue increases. So again, there is fear priced into this stock right now. Now, if we look at Coca-Cola from a dividend perspective, and we can see this recent sell-off has pushed that starting dividend yield again above 3%, sitting at about 3.11%. And again, to put things into context, this company is another dividend king with over 50 consecutive years of dividend increases. Now, the dividend growth has really slowed down over the past decade. 10-year dividend CAGR of about 4.75% and a 5-year dividend CAGR sitting close to around 4%. And they do use the majority of their earnings and free cash flow to pay out dividends. But as we can see, from 2019 to 2023, free cash flow has been covering those dividend payments, and the free cash flow payout ratio has pretty much stayed in the range of about 80% for that time period. And if we jump over to our stock screener and plug in Coca-Cola, and we can see this is by no means a high growth company. It's definitely in its more mature stage. But like PepsiCo, the reason people love this company is because of the predictability and the stability of their cash flows, of their dividend payments. And one advantage this company does have is their pricing power. If we jump over to the profitability sheet, we can see the margins for this company are very good. 10-year average sitting at about 60.5, and last year's was sitting at about 59.5. So not too much of a difference with that 10-year average. It's remained pretty steady during that time period, so pretty decent margins. Now, I made a video on Coca-Cola fairly recently, and it was before this huge sell-off over the past month. And basically, the reality is that Coca-Cola often trades at a premium. It's typically a pretty expensive company. It's the Warren Buffett effect in play. And even with this sell-off, I still think the company is trading at a slight premium. There's no doubt this is an expensive company, with a forward price to earnings sitting at about 21.67, and if we look at earnings expectations, again, earnings estimates, and scroll down, we can see they're expecting around 6 to 5 to even 7% earnings growth, which is decent for a company that's this mature, but again, over the long term, not necessarily great growth. So I wouldn't expect great dividend growth. That doesn't mean Coca-Cola is not a good company, it just depends on your goals as an investor. If you're a defensive investor or someone more focused on capital preservation and looking for very predictable streams of dividend income, companies like Coca-Cola and Pepsi right now could be a good choice. But as for me, I'm looking for companies that will grow free cash flow and dividends at a higher rate. So there you go, those are 5 different dividend stocks currently trading right at their 52-week low. Go ahead and let me know what you think of these companies in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.